Hey guys, what's up? This is Dungawat. We are going to discuss today out of syllabus with Dungawat. Whatever there exists in business domain, basically startup area where new startup ideas come. Today our topic will be out of syllabus. So we'll be discussing with Dungawat. We will clarify each and every topic in detailed manner. So without further delay, let's start our discussion. So first article, this you might have heard about pets.com. This was one of the hyped startup that became a huge famous in 1998. What happened within 1 year, 1.5 year, one and a half year, this startup failed and then it went bankrupt and then finally it was closed. Right, too much litter was there and then too few funds and then finally demise happened. What went wrong, what went good with them, and then what was the rivalry going inside the industry. So these things we will discuss. First thing first, what is pets.com? Pets.com, this is basically online company. What they will do, they will basically supply pet products such as dog food, dog toys through online e-commerce model. It was started in 1998 and then it was a huge market at that time. If you go to United States of America, there are a lot of pets. Like if go to each and every family, they have at least dog related to their family. So they have seen this as a visible model and then they even thought that this can generate huge revenue. So with this confidence, they haven't put lot of money by themselves, basically founders. Amazon had seen the opportunity to seize the market and then they had invested almost around 30% through venture capitalism. Even a lot of venture capitalists came, they invested. They invested in such a way that they thought company will grow like anything. Even at that time market conditions were so good that everyone were thinking that market will go in good direction. But what, analysis always leads to paralysis. We shouldn't go too much in analysis. Yes, analysis is very much important, but at the same time analysis may not lead tangible results as you might have you know thought. So basically what went wrong for them, right? They shipped products, dog food, those bags are heavy high, and then even toys also with high cost. Transportation cost was very high, even employment cost, those people who were supplying this delivery cost became very high. At one point of time their quarter revenue was, suppose say 1 rupee, they have spent almost 6 rupees in advertisement campaigns. Right, the advertisement, basically this Super Bowl commercial with sock puppet, they spent too much money in that. They thought business is going well, you just bring advertisement, you bring too much advertisement campaign into the minds of the people, then the behavioral pattern will change and then they start buying. That was their thinking process. But at the end people watched advertisement, it was beautiful, but no one bought because there were a lot of competitors outside there. So we will analyze that through this Porter 5 forces analysis. Even transportation was very expensive and then shipping costs were very high. These things went very wrong for them. Then right, they have raised almost 18.5 crore dollars as of today's value. What do you mean by 18.5 crores in Indian context? 18.5 means 19 crore dollars, means almost 181 crore rupees they have invested. So that is too much money. They ran out of money and then finally at the end of 1.5 year they have shut down their go down. Even when they went for IPO, initial public offering, their stock price listed was dollar 11 rupees, $11, sorry. Then at the end of 1.5 year it just tanked to 22 cents. Many of the investors, they were betrayed and then company eventually gone out. So why this is important? Pets.com, this is like one of the famous for failing. Like there is a too much hype around the business, but there is no business sense in the company. So if you have these kind of traits, then business will definitely will be killed, and then it won't grow further. Basically, many of the time companies will be thinking that they will put a lot of money in the advertisement campaigning, and then it may help them push forward. If you don't do your homework correctly, advertisement or mouth of word, all those things will not going to help. If your product is genuine, and then your strategies are correct, and you are going as per the market demand, then those things, even if something goes wrong, then you need to continuously analyze and it will go in right direction. So you need to understand them in detail. So basically, there were suppliers who were supplying food to this pets.com. Those suppliers' power was very high, right? They can demand any amount of money from their side. So that margins became very important. They have to squeeze those margins, and then they have to deliver at lesser cost, and then it became very tough for them in transporting, even filling bags with huge quantity of the amount of pets dog. There were even several new entrants were there. This is basically online retail market. Anyone can come easily. You need to choose a market in such a way that there should be entry barriers, and then those barriers should be set high. Otherwise, you are prone to a lot of dangers inside the market. Market is basically cruel. So when it comes to buyers they prefer low cost food. They went with pets.com, but they also found similar products in the elsewhere. If you see substitutes, there are local stores are there, they were also similar thing. There was one key thing missing in pets.com: differentiation, even strategy also. They only thought about advertisement, but they missed completely about the strategy. Even they missed about differentiation of the product. They are also supplying the same product, their competitors also supplying the same product, and at the ease of convenience. Suppose say they want dog food within one day, they think they can go to local store, they can buy there. Why to wait to supply pets.com for 4 to 5 days instead of buying from local stores? This also creates huge issue. When you go to industry rivalry, there are many established competitors in online retail. This posed huge risk. If you do resource based view, what do you mean by like how industry was good, sorry, how pets.com was very good from their resource point of view? There were several tangible resources were there. They have wide distribution network centers around the country. Even this sock puppet mascot, it became a brand symbol. They established the brand, they did advertisement campaign, it was good, but they couldn't monetize out of it. They couldn't even put into minds of the people, and then it couldn't go further. They produced memorable ads, but they struggled with e-commerce logistics. Even those kind of campaigns didn't lead to profitability, even cost leadership also. This is the article about. So next big concept we will discuss about search fund. Many of the time people will be thinking that you need to, in order to give a shot to start a huge startup, you need to put a lot of money, you need to have a good idea, you need to work hard for 2 to 3 years. Ideally it may go beyond 2 to 3 years also. Even then success also not sure. 96 to 97% of the time new startups always fail because they are new, they cannot understand all the constraints, because startups are concerned with unpredictability. So in order to avoid such kind of unpredictability, and you want to do still startups as an entrepreneur, you can still do. How you can do, right? This is where search fund comes. What do you mean by search fund? Basically, you are an entrepreneur. What you will do is you will put 1 or 2 years or at least 3 years studying the organization, existing organization, small enterprises, or like family run businesses. They are not that modernized, but they are profitable, and you can have a vision that those organizations are going to grow big in the future, and then you can bet on them. So then after that, what you need to do, you need to scale them up. You need to acquire them, you need to scale them up, and you need to expand the business. So what you will do, you have to attract investment from investors. This will be done in two parts. Basically, when you select the good company, automatically investor will come and then they will invest some money, right? They are not fool. They directly come and investing money. They will put some amount of money and then you start running the organization. You conduct day-to-day operations, at least with one or two areas where you will be monitored on each and every parameter on pilot mode basis. If your parameter succeeds and then it is growing good, and then there is hope that future cash incomes and then future vision is there, then they start to invest in the company in the second round. Then they will make you CEO. Then you can you can run the company like anything. Why this is good? Because company is already making money. You will not lose. You just need to add something on it. You don't need to build everything from zero to hero. Like, you don't need to bring any disruptions here. You need to understand lacunae in the market. You need to adjust accordingly. Investors like it because investors also don't want risky investment. Like, they want their risk to be lowered. So you can become CEO, you can grow with your ideas and skills. This is, just starting point in India. There are kind of typical returns as per study, almost around 25 to 35%. It is good area, so mostly it may grow soon.